Hi, I'm Jimmy. In this video, we're looking at ExxonMobil, ticker symbol XOM. So we're going to look quickly at Exxon's business, then we're going to look at some of the numbers, and then we're going to try to come up with a fair value for Exxon's stock using discounted free cash flow. Now, one of the reasons that we wanted to look at this stock is, as you may have heard, oil is trading up near $100 a barrel, which in theory should mean more profits for oil and gas companies like Exxon or Chevron or BP. But before we jump into that, I just want to take a quick minute to tell you about a website that we're building. So the purpose of this website, which is, by the way, expected to be up and running by the end of the second quarter of this year. So within a couple months, this should be up and running for everybody to use that is part of the community. One of the main goals of the website is to allow us to quickly and easily enter a bunch of tickers that we can try to come up with a fair value for a stock to help us decide whether or not we should research that stock further. So as an example, when we get to this one, which is Lowe's, well, we can see we get a fair value of about $201 per share using 7.5%. Now, the common textbook method to use would be to use the weighted average cost of capital, which in this case gives us a fair value of $163 per share. So this might be a stock that we want to skip. But basically, just so we're all on the same page, what this is doing is it's taking analyst estimates for free cash flow. Those are the green numbers. And we can see up here, it tells us how many analysts are projecting each of the numbers. And if we want the computer to go further, we can see in this example, I'm going out 10 years. So the computer's projecting out all the way out to 2032. And then with that, it discounts it back to today and comes up with the fair value, what we should pay for today. We'll also have the option to enter our own margin of safety. Let's say we had a margin of safety of, let's say, 15% for a stock like Lowe's. Well, the fair value, instead of paying under 201, we should pay under 171, assuming we're using 7.5% as our required rate of return. If we wanted a 20% margin of safety, well, now we should pay less than 161. We can adjust the revenue growth if we wanted, right now the computer's projecting it based on historical averages, but if we think those are too conservative or too aggressive, we can adjust the revenue growth. We could use our own numbers. The point is, the goal is to quickly and easily and accurately come up with a fair value for stocks. So if you'd like to sign up to get access to this website once it goes live, and in the meantime, you get access to our private investing community. We do private live streams over there 3 times a week. So if you'd like access to that, I will leave a link down in the description below. Okay, now back to ExxonMobil. Okay, now let's jump into Exxon's business. So this is Exxon's revenue according to their segments off of their 2021 revenue numbers. And we can see that their downstream business generates most of their revenue. It's almost 80%, followed by chemicals and then upstream. And just so we have a basic understanding of how this works, put together this graph over here. And we can look at the oil and gas business, and pretty much all companies within this industry will operate in a similar fashion. There is 3 main segments. We have upstream, midstream, and downstream. Upstream is things like if they're drilling for oil and gas, or if it was fracking or offshore drilling or something like that, all of that's considered upstream. That is when they pull the oil or gas out of the ground. Midstream is when they transport it, or they store it. So whether they do it by pipeline or via ship or boat or truck, or even if they have storage containers, those are considered midstream businesses. Now, Exxon actually doesn't list midstream as one of their primary lines of businesses, but a lot of other oil and gas companies will, so I just want to share what that was. Then downstream is both the refining business as well as retail. They call it marketing. If you were to go to a gas station, that's considered downstream. So that's refining is when they take the oil and gas, or oil, and they convert it into something like gasoline. And then they sell that gasoline to people, to customers at their local gas stations. That's all considered downstream. Now, we saw that their downstream business dominates their revenue. But there's a caveat to that. One of the tricky parts to the downstream business is something known as the crack spread. So when you got an oil company like ExxonMobil, well, they pull the oil out of the ground. They then ship it over to one of their refineries. They convert that oil into gasoline. They refine it into gasoline. That means that the feedstock for them, the expense there, is oil. So with rising oil prices, that in theory is a higher expense. But the price of gasoline also goes up. The difference between what it costs them for oil and what they can sell it for is in something known as the crack spread. Now, there's all different types of crack spreads. The one that I'm using here, just to illustrate an example of it, this is known as the 3-2-1 crack spread. Basically, what those numbers mean is it's 3 barrels of oil get converted, in this example for this math, 3 barrels of oil get converted into 2 barrels of gasoline and 1 barrel of diesel. And if we're curious, 1 barrel of oil is about the same as 42 gallons of gasoline. That's about 159 liters. So that's how those numbers convert. But we can see that when we look at the chart, well, recently there's been a big spike in the crack spread. This implies that profit margin for the downstream business are becoming more profitable. Although you may notice that over the long run, the crack spread generally doesn't get terribly high. Up where it's at now in the high 30s is right near the top over the past decade or so. So I wouldn't be too surprised if this pulled back as gasoline prices are sort of forced a little bit lower, assuming that oil pulls back at some point. So this somewhat limited profit margins in crack spread also helps explain this next chart. So this is each of Exxon's profit margins according to how they define each segment. The downstream segment, which again generates the vast majority of the revenue. The blue bars are the revenue numbers, and we can see that the profit numbers for their downstream business is much, much smaller. Only about 1% of the revenue generated in the downstream business is converted into profit. Now, sure, we saw a recent spike in the crack spread, so it is possible over the next quarter or two that we're going to see a slight uptick in those numbers. But just glancing real quick at the green numbers on this chart, well, we can see that the upstream business, although it generates the least amount of revenue, also generates the largest amount of profits. One of the reasons for that is that the expenses behind the upstream business, don't forget upstream is where they extract the oil and gas out of the ground, well, the expenses over there tend to be fairly fixed. I've done research and we've looked at what the average expense for Exxon to what is the average cost to get the oil out of the ground. It is estimated that somewhere between, call it $30 and $33, $34 a barrel is what it cost Exxon to get the oil out of the ground. So if oil was at, call it $33 per share, Exxon would be breaking about even in their upstream business. With oil sitting up where it is right now, up near $100 per barrel, well, clearly they're making a ton of profit for that company. So it looks like Exxon could be a very interesting company with oil prices this high. Now, one of the common pushbacks that I get when I analyze oil and gas companies is that basically oil is dead and a lot of things are going electric. And I agree that that is the future. I do believe that that future is a while away. So I was curious if I was researching different ways to see what actual consumption of oil and gas is. And interestingly, we have an index that is the total world consumption of oil. And we can see that outside of the dip that we saw in 2020 from the COVID-19 virus, which is very logical on a worldwide basis, outside of that dip, the trend is quite obviously heading higher. So although companies like Tesla are making an impressive dent in the quality of electric vehicles, oil consumption continues to rise, which means, at least in the foreseeable future, companies like Exxon and Chevron and BP and companies along those lines are likely to continue to do fairly well. Okay, now let's see if ExxonMobil stock looks like a good buy today using our discounted cash flow calculator that I mentioned before. So when we punch in ExxonMobil's ticker symbol, well, using our own required rate of return of 7.5%, well, we get a fair value of about $92 per share. Using the company's own weighted average cost of capital, which accounts for both the cost of their debt and the cost of their equity, well, we end up with a fair value of about $95 per share. Now, personally, I prefer to be a bit more conservative. So given a choice between those two numbers, well, I would likely go with something like the 7.5%. But there is one other issue that concerns me. So the way this calculator works, just so everybody's on the same page, well, the calculator takes analyst estimates going out the next few years. And in this case, we've got 3 years of analyst estimates. So we can see they got 37 billion, 27 billion, 31 billion is what analysts are projecting. The reason for that volatility is in order for an analyst to project what ExxonMobil's revenue is going to be, they generally have to also project what oil and gas is going to do from a cost per barrel. Well, if you go to one of the big investment houses, something like a JP Morgan or a Goldman Sachs, well, they're going to have a commodities desk. They're going to have analysts that all they do is analyze commodities, and they're going to be there trying to project oil and gas. It's likely that the ExxonMobil analyst is leaning on what the commodities team at a Goldman Sachs or something like that is doing. So that's where those numbers come from. But I actually prefer to be a bit more conservative than that, and here's why. Look at this free cash flow chart. This is actual free cash flow numbers that ExxonMobil has generated over the past 2 decades or so. And if we were going to define this in a word, I would call this, probably a good word would be volatile. It is somewhat all over the place. Now, granted, they are coming off of a very solid 2020, but I do hesitate with taking the high level of estimates. Yes, right now oil's up at $100 a barrel, whatever the number is, but it is not likely to stay there. I believe that oil is likely to pull back. Now, from what I could find of analysts, most analysts are expecting over the next couple years for oil to be up in the higher region, call it mid-90s, low 100s. That seems to be where a lot of analysts are expecting for this to stay, at least over the short future, let's say the next couple of years. I actually think that that is possible, yes, but it might be a bit too aggressive, and I much prefer to be conservative. So with that in mind, I've gone ahead and made some adjustments to our discounted cash flow calculator, and I'm not using analyst estimates in this case because I want to see what the fair value shakes out to be if we were going to be more conservative. So back at our DCF calculator, well, what I've done is I've eliminated analyst estimates. On the website, there's going to be a box you could check that says, hey, don't use analyst estimates. Generally, I think it's a smart move if there's only maybe one analyst estimate, but if you have a thesis, for example, my thesis is that oil will not stay that high, and you wish to adjust those numbers lower, it could make sense to do that. Now, for me, what I've done is I've just let the computer project out revenue, free cash flow estimates. So we can see that the big difference here is that, yes, we are using sort of a linear number, and I don't expect these numbers to come in exactly like that. We saw the volatility in free cash flow already, but I do expect that over the next year, maybe free cash flow doesn't shake out to be 17 billion like we see here. Maybe it is 37 billion, and then maybe over the next couple of years it's much higher, and then for a few years it's much lower. Maybe there's something crazy happens, we have a near flat year. But if over the long run, over the next 10 years, we can shake out to be somewhere on average close to these numbers, well, that would imply that the fair value using a 7.5% required rate of return would be about $89 per share. Now, for me, again, you've got to add a certain level of, you got to add a margin of safety to this calculation. I think on the low end, I would be in the 15% margin of safety range, which means I might be interested in buying this stock if it dropped below $76 per share. Another way, you might even consider going 20%. That might be even better and more conservative. And again, if that's the case, we're looking to buy this stock below $71 per share. Now, they are paying a decent dividend. We got a dividend yield of about 4.2%. So if we are dividend investors, this might be an interesting stock to consider. But I had analyzed this company about 18 months ago, and at that time, the dividend yield was about 8%. Well, the stock was like half the price it is today. To me, that was way more interesting than it is at this level. So as much as it looks like they are improving their free cash flow numbers, certainly in recent history, and as good as it is that oil is up at these levels, I just think ExxonMobil is a bit too overpriced right now, in my opinion. Now, if you'd like to get access to this website so you'll be able to punch in your own companies, your own tickers, and try to come up with your own fair value for all of your stocks, well, there will be a link right here. There's a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thanks, and I'll see you in the next video.